Wanted to take a look at the stock market today, SPX and of course SPY Stock. What's going to happen this week? We've got GDP coming out on Thursday. This is the second look. Shouldn't be too much of a player on moving the markets too much. But on Friday, we also get PCE along with personal incomes and personal expenditures. These three are my primary analysis data points that I always look toward. It's also the PCE is what the Federal Reserve will be using to determine the future of interest rates. Now we got CPI data, about 2 weeks ago, and that kind of showed us that we're on pace for lower inflation. The rate of growth is declining, which is great news. More than likely, the Federal Reserve will be in a position to lower interest rates at some point. They're targeting roughly the end of this year. My thinking is that's probably accurate in that the Federal Reserve is going to have to move quickly to get interest rates in line in a more accommodative stance after they've restricted so much. Let's jump in. I want to show you a couple charts I'm looking at and kind of keep the pace of what's going to happen, what could drive the stock market this week. Let's jump in. Here's a look at personal incomes versus personal expenditures. This is the year-over-year change. And as we go, I go all the way back to 1990, kind of the modern economy, if you will. The rate of change in incomes and determines basically the rate of change in expenditures. If the rate of change, the year-over-year growth rate in incomes is increasing, expenditures will follow suit. What drives personal incomes? More and more people getting hired. Raises. Those are the two variables. We kind of have peaked a little bit. We're at 3.9% unemployment at this point, and it's starting to increase, which means employment is declining. That could show us that there's more moderation in the rate of growth for personal incomes, which translates into the moderation in personal expenditures. Those expenditures, this is over 70% of the U.S. economy, and the one that fluctuates the most, those expenditures drive revenues for companies and profits. The latest numbers we've been seeing are just below median for this entire chart for both personal incomes and personal expenditures. So we're kind of moving at this point at a subpar level, just below median. Personal expenditures drives inflation, price pressures. And as you can see, the blue in this line is personal expenditures versus the core PCE. I'm using the core PCE here because it takes out volatile food and energy. We're seeing a continuing decline in PCE, and likely that's going to continue on Friday. But what we're also seeing, and this is sort of the asterisk or the bullet point you want to take away, is expenditures and income are not moving as high. That means same thing for the stock market. I think the stock market's played out. Today's price movement, walking into this week, of course, the market shot up, and I had some options trades I had just placed, took some profits real fast, left a little bit on the table. But then at the end of the day, the stock market kind of sold off. You've got stocks like NVIDIA and a few others of the big sort of seven that are moderating a little bit. Meta, I think I saw moving higher, but NVIDIA kind of sold off. It's way overpriced. And that might be driving things in the next couple of days. For me, looking for PCE, we'll probably get reiteration. The market may actually just blow this off simply because we already got CPI data. Now, the 10-year Treasury has softened a lot where it was recently, but it did pop up a little bit today, sitting around 4.25, not that big of a deal. Here's a chart I wanted to show you. This is real personal incomes, the blue line, versus real GDP. Real meaning inflation adjusted. And GDP growth, this kind of threw me off because incomes over the past, since I think it was about 2014, income growth has exceeded GDP growth, which I thought was interesting because I would have thought it's the other way around because income growth has been lagging over many years. But as this chart shows you, on an inflation adjusted basis, income growth is outpacing GDP. That should propel GDP because income determines expenditures, which expenditures is largely the economy or GDP. I don't expect too much in the way of this Thursday's number from GDP. We might get a revision of 0.1 or 0.2 up or down. It will reiterate that the economy is beginning to slow, that the pace isn't as high as before. That does not mean recession, but the stock market might not like that. Here's a look at the U.S. 10-year Treasury yield. This is the benchmark, and the benchmark rate has been kind of sideways. We're 4.26%, call it. This is, or 4.27. This is your benchmark investment rate. You look to this, then you ask yourself the question when you're looking at any other sort of stock to get involved in, what is the yield over the next 4 quarters, 12 months, if you bought any particular stock at that particular price? Your alternative, safer investment is the 4.27% in the U.S. 10-year Treasury, and that has been flatlining for about 2 weeks now after popping up, pushing almost 4.65%. I don't see 10-year Treasury yields going beyond 4.65%, even as high as 4.5%. I think we're done with those high numbers. Myself, I've been getting involved in TLT stock. For those of you who've been following me for any period of time, the latest dip that we saw just a couple months ago, April into May, I bought heavy into TLT stock. This is the ETF, which trades against the price on the 20 and 30 year treasuries. I expect them to continue higher over the course of the next 12 to 18 months, maybe 24 months. I'm going to sit on this for some period of time because I think stocks are way overpriced. I think the consumer is tapped out. We're going to see higher unemployment. We're going to see lower growth on personal incomes and therefore expenditures. I expect the stock market to begin to slide and sell off. The Federal Reserve will be lowering interest rates, not because they've hit a soft landing, but because they've restricted economic activity too much. But it was too high to begin with. I mean, we were at 3.4% unemployment at one point. That's 60-year highs. So to see it moderate the economy, getting down to a level that is more in line with normalized growth levels, that totally makes sense. The stock market will have to have a reckoning with that making sense. In the meantime, here's a look at, this is the S&P 500. This is actually SPY stock. It did sell off down to about 543.75-ish. I think it closed for the day. So after I had taken this, it had started moving lower afterwards. But it's been on a continuous move higher for over a month and a half since that latest drop below the 500 level. I could easily see us dropping further. I do not necessarily see the stock market is just going to continue up, up, up. There's not enough economic data to support that. Interest rates. Again, the Federal Reserve is going to have to lower interest rates. The rationale is simple. They've restricted economic activity too much. The rate of expenditures turning into revenues for companies, it's going to decline. Savvy investors will hit that sell button long before the retails. Given that, myself, I'm playing very short-term options trades, looking at intraday moves more so than taking a long-term position. I think my long-term positions, as I just said, I'm in bonds because bond prices are going to go higher because the Federal Reserve will lower interest rates. Given that, I do not expect that the stock market will just continue higher. Nvidia is starting to sell off, making more sense because it's way overpriced despite all the sales they are getting. Nonetheless, I'm going to keep you guys posted on this information. Make sure to hit that like and follow button where I'll break down the economy and how that affects the stock market. See you in the next video.